So let's get started with Relative Strength Index, RSI. Now, in tonight's class, I'm going to share with you a couple prepared presentations. In these prepared presentations I'm going to share with you, they are not re-recorded into the recorded version of this webinar. So when you see, if you're looking at the whole webinar, you'll see blank spots where it'll say video or something. If you want to see these particular presentations, if you go to YouTube and don't do a search, go to YouTube and look for the channel called Forex and CFD Education. Once you get to that channel, look for the playlist that simply says RSI, and you'll find it. Or if you do a search in the internet, I'm sure you'll find, and do a search for RSI, I'm sure you'll find the playlist for Forex and CFD Education. Also, if you notice on your screen, there are some handouts I prepared for you. If you do not download these now, you will not have access to them in the recorded version. You can only get these downloads in the live class. So please click on the download button, download them to whatever device you're using, and then you can move them around later. They are PFDs. There's one called the Relative Strength Index Guide handout, which I prepared for you, which goes into detail about RSI. And I've also given the Introduction to Technical Analysis ebook from investing.com. In tonight's class, I'm also going to use the term security. I may use the term asset. I may say Bitcoin, or I may say the euro, I might say Apple. But I'm not referring to any specific instrument. I'm referring to any instrument that is publicly traded in the financial markets. Okay, it just gets very boring saying security, security, security over and over again. Similarly, I intermix the terms investing and trading. And over the years, I've gotten some not so nice emails from people saying, don't you know the difference between investing and trading? Sure, I know the difference. You know the difference. Investors take a much longer term position, while a trader takes a much shorter term position. In either case, the basic concepts and techniques presented in this class are equally adept. It just gets very boring saying trading, trading, trading over again. So sometimes I say trading, sometimes I say investing. Now, the question many of you here would like to answer is, should I buy today? Should I sell today? What will the prices be tomorrow, next week, next year, or in a few minutes from now? Now, wouldn't investing or / trading be easy if we knew the answers to these seemingly simple questions? But to be honest with you, I don't have a Ouija board and I don't have a crystal ball. So if you're attending this class in the hopes that technical analysis has answered these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis, especially using RSI, will improve your investing or trading, that it will do. So let's talk about this RSI, or Relative Strength Index indicator. Now, the Relative Strength indicator is a momentum indicator. It was developed by a technical analyst called Wells Wilder. Wells Wilder is quite well known in the field of investing. Okay, he's developed a lot of indicators and written a lot of books, and he's very well respected. But if you notice, he published his concept on RSI in 1978. So what does that tell you? Well, in 1978, we didn't have PCs, we didn't have the internet, we didn't have online trading or investing, we didn't have Forex, we didn't have CFDs, and the world was a much slower place. So RSI was really developed for the stock market, because the only other things that were trading in those days were really futures or agriculture in commodities, but they weren't open to the general public. So without going deep into the workings of RSI, it's primarily used to attempt to identify overbought and oversold conditions when trading an instrument. Now, the amazing part is as this miracle called the internet developed, and as we actually started getting PCs, personal computers, because in 1978 we had some, I don't even know if we had some computers in 78. I remember when I was just starting to trade, and that was in the early 80s, there were computers, but they were, these DOS things, and they took up whole rooms that had to be air conditioned, and you had these black screens, and very few people had access to them or use for them. There was no internet. So they were just a big data storage encyclopedia thing that allowed you to pull information. So in those days, we had ticker tapes, barely had fax machines. So the RSI, or RSI, is called an oscillator. So an oscillator is a technical tool we as traders use to give us indication of whether an instrument is overbought and oversold. And an oscillator tells us exactly what. What do we see in oscillators? Well, like radio waves, they oscillate up and down, up and down. Do you remember the old movies? You see this guy looking at a radar screen and it had this thing oscillating up and down, making waves across the screen. That's an oscillator. An oscillator wasn't just for the financial markets. But we use these overbought and oversold extremes to see which direction the price action will have momentum. Oscillators are typically used in conjunction with other technical analysis indicators to make trading decisions or entering trades. There are a few oscillators like RSI, ROC, and MFI, and stochastics and MACD, and I'll be discussing relative strength indexes, one of the most popular indicators in the marketplace. It's popular because it's withstood the test of time. Now, it also falls into this group of oscillators or indicators that we call bounded oscillators. Why is it bounded? Because its numeric calculation will always come out between the number of 0 to 100. So it's bound between this field of 0 to 100. And RSI takes the average days when an instrument closed up or down and calculates them, because it believes in if prices are moving up, it will have more days closing up and it will close near the top of the price. If an instrument is coming down or trending down, it will have more days near the bottom of that instrument. So I've got a little prepared video for you, a presentation for you on the calculation. You'll never have to calculate this. It'll never, ever. It's automatically dropped in the screen, but you need to know what makes up this calculation so you understand how it works. And then we're going to go over and look at these things on charts and start learning what it actually is on a financial chart.
So for those of you who are fans of the maths, here's the calculation for the RSI. So the RSI is 100 minus 100 over 1 minus RS. So what is RS in this equation? Let me explain, because this is really at the core of the RSI. So RS is the average of X number of days up divided by the average of X number of days down. So to put that into plain language, let's say we're using a 10-day RSI. So it looks at, over the last 10 days, how many days did the market finish up? And it adds the total points gained on those up days and divides it by 10. So we have an average of the points gained when the market went up. And of course, the inverse applies down here. If out of the last 10 days, the market went down for 4 of them, the number of points lost in those 4 days are added up and divided by 10, and we end up with an average. Okay, and once this gets plotted on the chart, we always have a value between 0 and 100%.
Okay, so that wasn't too painful. But that's a simple way to calculate RSI. Okay. Now, the default lookback period, or the standard parameter for RSI, is 14. Now, the two most popular look-back periods are 14 or 10. And this is really up to you personally. So let's go over and let's take a look on a live chart and see what this indicator is. So I've got here my teaching chart. This is a chart I use for all classes, and it's for the euro US dollar. Okay. It's got nothing to do with any recommendation or whatever. I always use the euro US dollar chart, and I usually use a 30-minute chart. So we're looking at the euro US dollar for 30 minutes. It's the current chart. And if we wanted to put RSI on our chart, we would simply go up to indicators and locate RSI and click on it, and it would drop it on our charts. So I've got it down below, and RSI will go on your chart below the price action. It doesn't, like what I have on there now is a moving average. Moving average goes on your chart on price action. RSI is dropped below your chart. So what it will do is it will do the calculations for you and drop the RSI in your chart. And this one line is the RSI calculation using a standard default of 14 periods. And that would have been dropped into the calculation you just saw below. 100 minus 14 times the division of the points up and the points down. Okay. And it's dropped below. Again, you don't ever have to calculate it. But that doesn't tell you much. Now, as I said, RSI is a bounded indicator, so it will always come out between 0 and 100. And so the 0 to 100 is plotted on the right of your chart. Okay. But again, that's only a bit of information. Now, RSI, as we told you, tells us if an asset is overbought or oversold. Okay. These are based on specific limits that were developed by Wilder. And these gives us an upper band and a lower band. These are at 30 and 70. And now what we have on our chart is our upper and our lower band of the RSI. When prices are above the 70, they're said to be overbought. When they're below the 30, they're said to be oversold. Now, this is the standard. There are some people in the marketplace that teach you an 80 and 20. Okay. That's like almost a personal decision. What it means is if you're using over 80, the asset will be overbought, and that would just take out a lot of the iffy signals before and afterwards. But Wilder developed this with a 30-70 boundary, which are these lines here and here. This purple area I've colored in for you has very little say. This is almost dead man zone. The indicator's doing nothing when it's in this purple area. It's only when it breaks out above or below. And this is RSI on your chart. Okay, not very difficult. Now, what does a momentum indicator tell you? If you think of a momentum, just like you think of momentum in physics, and if you shoot a fireworks into the sky or a rocket in the sky, it's going to go up and up and up and up and up and up and up. At some point, that rocket is going to slow down. Doesn't mean it's come back down to Earth. It means its momentum upward is slowing down a little bit. As it's slowing down, it's reaching its maximum height or its overbought zone, because the asset is now, the momentum is starting to wane. Now, when that momentum wanes and we see that rocket easing down in its momentum, we know it's going to fall back to Earth. It's the momentum can carry it farther up, And depending on a whole bunch of conditions like wind and airspeed and weather and the dampness in the air, okay, it could carry it up for a little few seconds longer, or it could fall a lot quicker. Same thing in the markets. An asset can remain in the overbought zone. It doesn't tell you it's going to flip down or become oversold or go into a sell position, or the selling trend is going to end. It's telling you that the momentum carrying it up is starting to lose its footing. And the opposite is true when it goes below the 30. Because remember, there's always a mirror or flip side. So this is the basics. This is only the basics for RSI. So let's go back over to my PowerPoint and talk a little bit more about what you can do with this now that you have it on your screen. So the question is, what market can RSI be applied to? Since RSI measures the relative strength of the underlying market, it is a technical tool that can be applied to almost any market. However, it is commonly applied to markets that are more liquid and larger, like Forex, stocks, and commodities. So let's talk about trading with RSI. Now, RSI is used in a number of ways. There are three popular functions that we get from RSI. We get overbought and oversold, which is the general primary use of RSI. But we also get RSI ranges, and we also get divergence. Now, a lot of times in media and analysis you'll be reading, or they'll say the stock is overbought or WXYZ is oversold. And they're usually talking about the stock's RSI reading. So when RSI is above 70, or 80 is often used as well, it will start to show that a strong run higher in price, which may not be sustainable, and therefore is due for a correction. So unfortunately, it's not as easy as buying when the indicator moves below 30 as selling above 70. Some confirmations are needed to confirm the price change of direction. So when the price crosses below 30 and then rallies back up before it buys. So in other words, when we see RSI falling below the 30 zone, or contrasting above the 70 zone, but when we see it fall below the 30 zone, we want to wait for it to fall down and then rally back up. That's the confirmation, not when it breaks, when it rallies back up. Okay. And hence we have the opposite when RSI reaches the overbought zone and then turns back down into itself again. Okay. That's when the price has actually made the change. Now we combine that with sometimes divergence, which helps reinforce the signal, or when it falls below the 50 line or above the 50 line. Breaking that 50 line can be very, very important to give you a clear entry or exit point to the market. So when a buy is triggered, a stop is placed below the recent swing low. A sell signal is used to exit long trades or initiate short positions with a stop above the recent swing high. So we can use RSI to pick our stop loss points also. I don't personally make that recommendation because I firmly believe that RSI is a good indication of momentum. Outside of that, I don't really use RSI because it doesn't give you specific entry and exit points. So we need to combine it with other tools. So during trends, the RSI will usually stay contained within certain readings. During an uptrend, it typically bottoms above 30 and frequently reaches 80. During a downtrend, the indicator will typically top out before 70 and frequently reach 20 or below. Now, the thing is, if you want to use RSI or stochastics, okay, because these are bounded oscillators, you have to be familiar with your asset. Because say, for instance, some their overbought level will be consistently 69, especially stocks, because when they move up, they don't move straight up and they don't move that fast. So their momentum starts to wane, and you'll find that some assets, 60, 69, 70, you'll find other assets like Bitcoin and stuff that have these huge spurts that you might be better well above 80 or 85. So by using this and being familiar with the asset and seeing what price it usually hits before it starts to turn down and how often it has strong momentum. So one of the other problems with this strategy is that the RSI may not provide an exit signal, in which case a winning trade may turn to a loser. For such occasions, having a price target or another exit method is necessary. Now, each stock moves differently and therefore may have a slightly different range. Adjust levels to suit the individual asset's movement. For example, 40 may be more suitable entry point than a 30. During a downtrend, short sells if a price rallies above 65 and then drops back. Place a stop above the recent high. Again, some assets give us this because you have to see how they operate. And it's just an important thing I'm mentioning because you don't want to go out there and just use this 70-30 rule. Now, as I mentioned before, divergence is also a great tool to use with RSI because it will help support what RSI is doing. Now, if you don't understand divergence, because you have divergence with many indicators, it's when the indicator itself is moving in one direction while price is moving in another direction. Okay. It's not a trend. Price is downtrending. The indicator isn't necessarily moving an uptrend. It just means it's making higher highs while price is making lower highs. And the two are diverging. And you can have bullish divergence and bearish divergence. Now, RSI have several limitations, as all indicators do, since the indicator is showing momentum. As long as momentum stays strong, the indicator can stay in overbought or oversold territories for a long period. Therefore, price analysis and some other confirmation tool is needed. The same is true for divergence. While the price may be dropping and price rising, that doesn't mean price will drop soon. The RSI is just showing you the price is moving higher at a slower pace than it was before. Confirmation of reversal is still needed. So let's go back to my charts. And so as you can see, to see divergence clearly, we have RSI on this chart in overbought territory and showing a divergence. Now, that helps us make some decisions, but we have to use other things on our chart. So here we have a beautiful double top position, and we've seen the asset make a top, then come down, hit the bottom, make a top again. So now we're looking for the price to drop through and return to its downtrend because we have the divergence and the overbought indication. So we have our target 1 price and our target 2 price based on previous support and resistance levels. But we're looking straight at that RSI overbought rule with the divergence. Here, we've combined two assets. We see stochastics and RSI both diverging from price, while price is moving in a uptrend. At this point, we saw both indicators diverging, or they were making lower highs while price was making higher highs. Now, at this point, they might be giving us a signal, okay, an edge up, but they're not, because RSI or stochastic don't tell you anything about an exact entry point, nor do they give you a price level, because RSI and stochastics don't give you price. You have to use other things or other tools to determine your exact entry point and where you put your stop loss and your take profits. So let me share with you another presentation that will show you generally how to use RSI. And then I have a fairly detailed price presentation showing you exactly a trade setups using RSI and divergence to make pricing and trading decisions.
So traditional uses of RSI. So you guys may well be familiar with these. I'm sure plenty of you are just doing a bit of a refresher. For those of you who are new, these conditions, these uses sound a bit weird, but they're actually quite simple, and I'm going to demonstrate them in just a minute. So the traditional uses, overbought and oversold, as well as divergence, and then some alternative uses of the RSI, identifying bullish and bearish ranges, and positive and negative reversals. Now, it just so happens that I did a separate YouTube video just yesterday on the upcoming Facebook and Microsoft results, and it's Facebook, I believe, that has a positive reversal in the RSI. So we can see if that pulls off. That's something to check out on YouTube afterwards. Before we get to that stage, this is the overbought and oversold idea. So basically, the idea is that when the market gets over the 70 level, so obviously, as we said, down here, this is the RSI, starts down here at 0, ends up here at 100. Over the 70 level, it's overbought. So between that 70 and 100, it's overbought. Between 0 and 30, it's oversold. So when the market dips down through this 30 level, it's oversold. So idea being that it's just the market suffered a bout of selling, the market's dropped a lot, and it's due a bit of a bounce back. So as you can kind of see from this chart, here we get the price breaks through the 70 level, and it keeps running higher, has a little dip, and then actually runs up and does a little pattern in the price, a little kind of double top pattern here. But you'll notice actually that it dips back through the 70 level, and that's when we start getting more of a sign that actually the market is topping out. So the general rule of thumb when you are using these levels in some way in your trading strategy is that don't immediately sell the market just because it's popped into overbought territory. Don't immediately buy the market just because it's popped into, because it may dip right down to 0 if things get really extreme, and equally 100 on the top side. So what you really want to see is the market pull out of that overbought or oversold condition before you then start looking for the opportunities. So sometimes it works better than others. We had a big run down here from the oversold condition, overbought, but then this oversold condition, we had a kind of little minor bounce back. They kind of grinded higher a bit. But then as you can see here, nothing's perfect. The market was pretty soft basically at this stage, and I'll talk more about this in a minute. It never reached up to the overbought condition because the market was in kind of selling mode at this point, and it just hovered around the midterm and then dropped again. So there was no RSI signal or based on an overbought level to take advantage of this particular trade. Again, you can't take every opportunity necessarily. So for this particular technique, The market got really oversold again at this point, and then actually this provided a pretty nice entry point with the benefit of hindsight. You know, by the time you get this signal of the RSI being out of the overbought zone, you probably already missed these first two candlesticks. But again, you know, you can't perfectly pick the bottom. The idea here is to kind of catch some kind of durable move in the market. So then eventually the market does grind high with not too much in the way of retracement, and actually, as you can see, pretty much comes up to the resistance here that we saw at the start of the chart. And then again, once you hit that, you know, you have that both the price as resistance as well as the RSI coming out of its overbought zone, gives you a little trigger to sell the market lower. So, word of caution here, if there is a strong uptrend, you can, you know, and certainly people do it, but I don't advise selling within an uptrend. It's just you're going against the flow of the market, and obviously that where the interpretation in this particular scenario that we're looking at is, you know, ideally you don't want to be selling the overbought conditions in an uptrend, because it's going to remain overbought for a while because people are buying it. It's an uptrend. So as you can see, the market will roll over from the overbought level, but it won't be durable. It won't even get down to the previous low, obviously. So it's difficult to find a price target. And when it does rip the other way, you tend to get these big, like, bullish engulfing patterns, and it will take you right back up to your entry point. So you can kind of go for it. A lot of the time, you'll get a scratch, you know, basically a break-even trade, or a few small wins. But, you know, it could just blow completely in the direction of the trend again and, you know, catch you out. Do you understand?
I guess one of the biggest secrets about RSI is pay less attention to the over 70 and the below 30. They tell you that the asset has reached an overbought or oversold condition. But again, we keep reiterating, an asset can stay overbought and oversold, or it can zip into overbought or oversold conditions, pull back down, bounce back out of it again. An asset can keep momentum going for, you know, if an asset was rising at a very high trajectory, a very hard uptrend, and that uptrend continued, but it was less intense, that could keep that asset in that overbought condition for quite some time. And so you don't want to look at that. If you're trying to use it to make price decisions, we find that the breaking of the 50 line is more important. So if you watch the center line, okay, you'll get some better clues. All oscillators have a center line, and more often than not, they become a forgotten backdrop compared with the indicator itself. RSI is no different, with the center line found in the middle of the range at the reading of 50. Technical traders use a center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy into that market. A drop below 50 would indicate the development of a new bearish market downtrend. So as you can see in this graph to the right, okay, we're paying very much attention to that 50 line. So we had RSI break above the 70, giving us the oversold condition here, telling the market was oversold. Okay. We saw it break above the 70 and go back into the 70. That's giving us a clue that we're moving into a downtrend. When we got the 50, that's telling us the momentum has actually shifted. At this point, it's a more detailed entry point, or you know that you can enter that market with a sell position. So you've combined an iffy indicator, you're just looking at an over 70 overbought, to a more precise indicator that's actually giving you direct implications to buy and sell. So RSI is popular because it has multiple uses. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help spot or confirm reversals via divergence. Like any technical analysis tool, though, the RSI is prone to providing false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels will be identified. So let me share this presentation on using RSI with divergence to find entry levels or how to enter trades.
Today we talk about divergences, and especially divergences on the RSI indicator, which are often very good trend reversal signals, and they very accurately signal when a trend is over. So let's start with the basics. What is a divergence? Divergence is basically when your indicator and your price action are not doing the same things. So for example, when you see a rally, price is going up, it's making higher highs, and usually your indicator does the same. But sometimes they are out of sync. So right here we can see it's going up price all the way, but at the same time the indicator, the RSI, is making lower highs, which shows that indicator and price action are not in sync anymore. So we can draw some trend lines here, and you can see that they are not in sync anymore. So this means that because the RSI is measuring momentum, which and it analyzes the size of your price candles, and also if you have more red or green candles. So this means that during the first trend wave here, you can see price has a lot of green candles, and they were much larger than the red ones. Whereas here in the second one, the second trend leg on the bullish trend, there were fewer green candles and also not as large anymore. And then during the final trend wave here, you only have two green candles, and the trend wave came to an end very quickly. And then even here, when it then moved sideways, we had some of the dojis, some of the hanging man or pin bars or kangaroo tails, whatever you call them, where you have this wick to the upside, and then price immediately rejects them and falls down, which is another clue that the trend is losing momentum, and the indicator just confirms that. So basically you don't even need the RSI, but I always prefer to use indicators, especially the RSI, because it adds some objective signals, and it takes out a lot of the emotional decision making traders often struggle with. So the RSI and the divergence is a very important tool in my trading, and I highly encourage it for you. So it's also important that to note that RSI divergences are only important after long trends. You can get a lot of divergences all over the place, such as here, for example, you have higher highs here, and here's some sort of lower highs. But you can see previously there was not a lot of trending going on, and also then the following reversal was not as strong. Whereas here it's a very different scenario. You have this long trend that was then slowly losing momentum. The buyers were leaving the arena, and then eventually price sold off and created a very nice reversal in the other side of the trend. So the first rule is always to look for reversals and divergences at the end of strong trends. Then if you want to trade reversals after divergences, the most important thing to understand is that not all reversals lead to a complete trend shift. So often after such a trend, and then you see the divergence, you just get some sideways price action and price is going nowhere, and you want to avoid those scenarios. So for that, I plotted the moving average on my chart. It's the 20 period, which I think works very well for those types of trades. And then the final signal that would then signal our short entry would be the break of the moving average. So you can see during trends, the moving average always holds up very nicely. It often acts as support, resistance, but once the moving average is broken, especially after such a nice divergence, then it usually creates those complete trend shifts, and we can filter out a lot of those sideways market tops that don't offer any trading opportunities. So we can look, and then after this bullish reversal, we entered this sell-off here, very nice. One time it breached the moving average but did not go anywhere. And then as price moved into the lows here, we can see that this bearish trend wave was very strong, lots of red and large candles, but then the second one here is much shorter, just like we saw here. So as we can guess, this would have brought us another divergence. The RSI made a higher low, whereas price made lower lows, a classic divergence, and then price started to move higher. Here it broke the moving average. Use the arrow again to mark it. It broke here. It did consolidate sideways and did not shoot up straight away, but it is very normal, and you can always see that. You cannot expect those clear up and down moves, and price sometimes need this time to consolidate and make up its mind. But eventually, price never really broke the moving average to the downside again.
So as you can see, RSI is not very complicated, but it gives you a lot of choices and lots of ways to apply it to your trading. Okay. And remember, you have divergence, you have overbought and oversold conditions, you have trading ranges, and you have your 50 line. All of those can be taken in consideration. Now, let me take you back over to my chart. Hold on one second, let me pop it up here. And back to the... Now, we can also adjust our RSI settings. As I said, you can decide to use an 80-20, which is one of the other populations, or decide which one is best for the asset you're looking at. But besides that, you can also change the length. Remember, in the beginning, we were talking about a 10 or a 14. Okay. The shorter the length, the more it's adaptable. And for us, since we're all trading CFDs in almost a day trading format, okay, if you're trading in small intervals of time, okay, you should be using either 10 or 14. If you're looking to make trades that close out in a relatively short period of time, you might want to adjust it to a 10. That will give you a more reactive RSI. 14-day period will give you a little bit less reactive. Anything beyond 14 puts you really out of our trading that we're doing for CFDs and Forex. But stick between the 10 and the 14. You'll see all kinds of gurus out there telling they use a 22.5, but those are their individual trading systems. Okay. Stay with the 14 or the 10 and the close. Adjust everything else, because if you adjust the time on your charts, your RSI will automatically adjust to fit your chart. So adjust your charts if you want a longer period, but that will give you a better, higher and lower will give you less false signals and give you less input. But it's one of the nice things that RSI is quite adaptable. So on that note, I think we're going to wind it down. Now, if you want more information on RSI, I've given you handouts, but you can also go over to trade.com, sign up for their education center, and use all of their RSI information. So on that note, I'm going to say goodnight to everybody. Thank you very much. And remember what I told you, in the recorded version, those little presentations that I share with you are not re-recorded. So you need to go over to the YouTube channel to see those recorded presentations. Thank you very much, and thank you for supporting trade.com. Have a good night now.